Good afternoon, and thank you for joining us today for our webinar, Applying Fiduciary Guidelines and Avoiding Retirement Plan Litigation. Our presenters today include myself, Joe Connell, and my colleagues Michael Johnson and Ginny Gribble with our Retirement Plan Services team. I'm going to focus on the new rules coming into retirement plans today and managing your plan in a fiduciary manner. So, unfortunately, fiduciary is an F word, and many of us have not really fully understood the responsibilities that are associated with managing an employer's retirement plan and being responsible for participants' money. And so I wanted to quickly define what a retirement plan fiduciary is and how important that role is in managing the responsibilities that go with your retirement plan. And so you can read there that a fiduciary is someone responsible for managing retirement plan assets on behalf of others and stands in a special relationship of trust, confidence, and legal responsibility. And the Department of Labor has taken that fiduciary responsibility and tried to expand that role to retirement plans. And really they started this process almost 7 years ago and have recently released a landmark fiduciary rule that actually does weigh in at over 1,000 pages that addresses fiduciary responsibilities and some of the new things that plan sponsors are going to have to pay attention to in the new rules set to take effect in April of 2017 and fully in January of 2018. I will say with the change of administration coming in, there could be possible changes to this rule. There are many groups still petitioning the courts to see different changes, but as the rule stands today, we're going to assume that most of the things inside of that rule stay in place. And I guess the question that we get from most of our plan sponsors today is why this new rule and how will it impact our organization? Well, as most of you know, ERISA was enacted a long time ago, over 40 years, and the retirement plan landscape has changed dramatically since then as we've moved from defined benefit plans to more of a participant-directed 401k, 403b, 457, and other type of IRA type programs. And as financial products are marketed directly to participants today, the Department of Labor felt that maybe they could do more to make sure that the advice that these participants were getting was made more on a fiduciary level versus the old practice being a suitability requirement had to be met. And they wanted this advice to retirement plan owners, specifically those in a 401k, 403b, or in an IRA, to have that fiduciary aspect to the advice where that everything that was presented to them had to be in their best interest and without conflict of interest. And so as an organization today, if you have a retirement plan and you are subject to ERISA, you probably want to focus on who your relationship is with regard to a financial advisor. And I know this can get complicated because there is no legalities to who can call themselves an advisor. So you could have a person today who does not operate in a fiduciary capacity using the term financial advisor. But it will be very important as this rule takes place in April to make sure that there are certain aspects of your advisor relationship that have to be possibly changed so that they can be considered a fiduciary on your plan. You might want to review agreements that you have directly with your advisor regarding compensation, conflicts of interest, and making sure that if they are going to assume a fiduciary role for your plan, that those agreements are in place and you fully understand the roles and responsibilities that advisor is working with you on your plan. And so the Department of Labor has been very clear in that any time a fiduciary, now an advisor working on your plan, always acts in the best interest of your plan participants. and they carry out their duties prudently, follow the plan document. Things like diversified plan investments, which have been in place for a long time. You might be familiar with something called 404C, which is a protection against not having that diversification in your plan. And then the Department of Labor has been focusing quite a bit of their time and energies now on paying reasonable plan expenses, which, although these are not specifically part of these new rules, these are fiduciary responsibilities that many of your advisors will take on responsibility for as they assume a fiduciary role. And so as a committee, we've been asked by many of our clients, how do you change your plan or your roles to make sure that these new rules are met appropriately and you're doing the things necessary to keep your plan running compliant. And so first and foremost is definitely just kind of understanding what your roles and responsibilities are, because it is not uncommon for us to begin a relationship and find that there hasn't been a lot of structure to the organization in response to their fiduciary obligations. So we'd like to establish a formal governance process, maybe have a committee charter of sorts that outlines roles and responsibilities. You might probably want to look at your document and make sure that you have a formal investment policy. Written records of your discussions, things that go on in committee meetings, decisions that are made with regarding investments. If you have specific responsibilities with regard to your committee, maybe a secretary role and such, you want to maintain very good records of those committee actions where you've documented the discussions you've had. Many times you might do a fee review, you might do benchmarking, maybe you do a full-scale request for proposal process. Very important to document your process and the results and what your decision was with regards to those actions. You want to conduct a regular review of your plan's investments, and we use the term regular review because depending upon plan size, sometimes annual could be enough, semi-annual, or even quarterly if your plan is over $10 million in size is probably the more suitable standard today. And then educating participants to help them make informed decisions can take many roles or different responsibilities. It doesn't necessarily mean you have to have a group meeting for your participants, but you do want to make information available to them on a regular, recurring basis that helps them understand your plan and the investments in your plan, whether you do that via webinars, printed material that you give them on a regular basis, email communication, handouts, anything that just helps your participants to better understand how the plan works and how they invest for a successful retirement. And then monitoring fees and services for reasonableness is where we're seeing a lot of litigation today, and we'll step into that just a little bit here. So monitoring fees for reasonableness, this is where a lot of plans today are finding themselves, unfortunately, facing potential litigation because they haven't really tracked their fees against benchmark or similar sized plans, both in nature of participants, in assets, and in the services that they're requiring from their plan administrator, being either a third-party administrator or a fully bundled plan with the record keeper being the compliance administrator as well, and not only looking at those fees, but also the investment advisor and consultant fees that you're paying. So there's a lot of components to those fees that does make it difficult sometimes for an organization to be able to benchmark those costs and make sure they're reasonable. And of course, a word like reasonable isn't really clearly defined, so you do have challenges in determining, is the fee we're paying, quote unquote, reasonable in the eyes of the Department of Labor? And as we've known from experience in dealing with fees, a very small difference in investment fees and cost, 0.5%, can have a very serious impact on reducing long-term savings for your plan participants. In our industry, the retirement plan investment industry has not made it very easy for an organization to clearly understand all the different aspects of fees that go into your plan. Multiple share classes from an investment firm where they offer a mutual fund, but it might have share classes from A, B, C, Z, I, R1 to R6. All of those share classes have different fee structures to them, and it's very important that you ask about those share classes and which ones you're using today and which ones might be available to you to help you lower your costs. And of course, fee benchmarking is essential to help you really understand how your fee compares with those similar sized plans. And the problem with not doing this is that the ERISA litigators have really grabbed onto fees as a leading point in terms of litigation on very, very large plans. And so this is sort of a summary of some recent cases where you can see the recent attorney awards are very high, and these are recognizable name companies, again, very large firms, Boeing, very familiar company, and settling a lawsuit for $57 million may not seem like a lot of money materially to a $10 billion plan, but it certainly gets the ERISA lawyers excited when they get settlements that are far above that in terms of the litigation fees that they're able to extract from the settlement. So again, this is a new area that we're seeing settlements come out in, but these lawsuits, many of them were filed 8 to 10 years ago, and they're just working their way through the courts, or settlements have finally been reached. And of course, as those time frames get very long, you can see that the lawyers are obviously getting some pretty large settlements, which include significant attorney fees in the nationwide case of more than $50 million over a case that had almost a 10-year life. And so how does an organization make sure you're doing the right things to protect yourselves? We talked about documenting, and that's the first and foremost thing you can do is document the actions you're taking. A fee review doesn't have to take place every year. If you do a very thorough job of analyzing all those different fees every 2 to 3 years and document that process, that's going to help you if you are ever facing litigation. Review the minutes of your previous meetings to make sure you've recorded your fiduciary discussions. Make sure that you list when you've had these investment reviews or if you've had committee discussions about roles and responsibilities. Review a fiduciary checklist. We did include a checklist in our handouts today, which is a nice step one in determining the things you're doing as a plan sponsor today. And finally, sort of having fiduciary education. Many providers offer that for you. You might be able to get that from your third-party administrator or your record keeper. And that was a good opportunity to sort of establish this culture of compliance. We've had several of our larger clients have Department of Labor audits recently, and these audits are not triggered anything specifically gone wrong in the plan, but typically it's due to some late deposits that they've seen on 5500s, even though they were corrected. If there's a pattern of late deposits, it generally brings the Department of Labor in for an audit in several cases. And by having a culture of compliance where you have meeting minutes and notes and discussions, you tend to get a much more favorable response from the Department of Labor investigator when you're trying to do all those things right and you have a process in place to manage your fiduciary responsibilities. So establishing a fiduciary binder and really trying to pay attention to these items will go a long way in both, obviously, dealing with the Department of Labor, but also dealing with any potential litigation. And so finally, I will close out mine with just, unfortunately, the litigation is not ending. We just saw some very significant new cases just get issued this summer, and many of these are provider cases where the major 401k providers that might be working with your plan even are being sued because they're using proprietary investments. They're using classes of shares that seem quite expensive for the size of their plan. And so many of these organizations have settled their lawsuits, and many of them are still in the process of just still fighting the lawsuit, trying to get them thrown out of court and such. But the lesson should be learned that using proprietary investments and not minding fees by all these providers would hopefully be something they realize when we've seen significant settlements already from the majority of them. And then just in the last 3 months, you see the list there of significant universities with 403B plans and 401K plans all being targeted for significant fee exposure, where they might offer several hundred funds with multiple share classes between those funds and no consistency. And there's extra cost associated with that type of expansive lineup, and in many cases multiple record keepers, so they're not getting economies of scale. And so we're just seeing the first lawsuits, and some of these names are obviously very significant, so we don't know where this will lead to. But again, the litigants are very active in looking at plans to see where there might be opportunities. There's many sites asking for participants of organizations to be a part of class actions. So as plan sponsors, we just want to continue to do the things we can control, which is obviously trying to help with our fiduciary processes and make sure we're doing internally what can be done to reduce our fiduciary liability under ERISA. So thank you for that opportunity to share some of the new things coming with the Department of Labor and also ways to help you manage your fiduciary responsibilities. I'm going to transition over to Michael Johnson for a retirement plan update.
Good afternoon, everybody. This is Mike Johnson. I'm one of the directors of retirement plan services here at Sikich, and we're going to talk about some things that might be changing the retirement plan area over the next few years. So on August 3rd, states are looking to start sponsoring state-run retirement plans. These retirement plans would be mandatory if you do not cover your employees under a qualified retirement plan, such as a 401k plan. One of the things they were waiting for was the Department of Labor to come out and say that these plans are not subject to ERISA, the Employee Retirement Income Security Act that governs retirement plans. So on August 30th of 2016, the DOL issued final and proposed rules that listed what these states had to do in order for them to be state-run plans not subject to ERISA. The basic program conditions are: it must be established under state law, must be implemented and administered by the state has the responsibility to invest the contributions or select the investment alternatives, the state is responsible to protect the employee contributions and savings, the state has the responsibility to notify the employees of his or her rights under the programs, the state must ensure the employees are notified of these rights, and employee participation must be voluntary. These state-run IRA programs, and Illinois was one of the first. There were 5 actually that are the front runners of this, and they were Illinois, Connecticut, Maryland, Oregon, and California. So they all have different rules, but they're basically going to be the same. So we'll go in general through the state-run IRA savings program, and then I'll talk a little about the Illinois program. So the state-run programs are going to require employers to participate if they do not have a qualified plan. To be exempt from ERISA, this is what they have to do. They have to collect and remit employee contributions, provide notice regarding their involvement in the program, provide the necessary information to the state to enable proper administration. So the employers are going to have to give the state information about the employees, their names, their social security numbers, their dates of birth, their dates of hire. They have to allow the states to publicize the program to the employees. They are not permitted to make any employer contributions, so they can't match. It's all just employee contributions. They cannot influence the employee's participation, so basically the employer can't say, I don't want to do this, here everybody complete a form and say you do not want to participate in the program. The employer cannot have any discretion, control, or authority under the program. It's all state mandated. And the employer cannot receive any compensation other than reimbursement for reasonable costs. So we'll go through the Illinois one. So Illinois Secure Choice Savings Program was actually signed into law on January of 2015, and it is supposed to be effective June 1st, 2017. I doubt it will be effective this soon because there are still things they need to do that they have not done yet. For instance, they haven't even selected a provider yet. But in general, what's going to happen is if they don't offer a current retirement plan, they're mandated to be in these state-run plans. The basic requirements of the Illinois plan, they're going to be indexed mutual funds. Any employer with over 25 employees that has been in business for more than 2 years is going to have to enroll in this plan. Now, 25 employees, from what I've read, is high. California's is only 5 employees. Ohio's is only 5 employees. Oregon, who was a front runner in this that just came out, I believe their requirement is going to be any employer with at least 1 employee has to offer these state-run plans. The state-run plans are going to be Roth IRAs. So the automatic enrollment level for the Illinois plan was set to be at 3%. So that means you're automatically enrolled unless you opt out. The Oregon one, again, since I've read a little more about that, was 5%. So their mandatory was going to be initially 5%. So the employer has to withhold, deposit, and enroll the employees, similar to what they would have to do in a 401k plan. The employees may opt out or choose a higher or lower deduction. So they could elect to put in 0, or they could elect to put in 5%, 6%, 8%, whatever they want. The employees can withdraw from the accounts at any time. The accounts may be transferred from one employer to another, and failure to comply for the employer will be a $250 per employee penalty the first year and $500 per employee for subsequent years. Now, some of this information will likely change when it comes out. The Department of Labor recently relaxed their rules. They said that employees had to have access to their accounts. You don't have to give them access, so they could limit it. Maybe they can't take their money until they leave. Or it's possible it could be similar to a simple IRA where the money has to be in there for 2 years before they can take it out. So a lot of these we'll have to see what these states end up doing. So now is a good time to consider a 401k plan or another qualified plan. 401k plans, simple plans, SEP plans, they all count as retirement plans. The advantages of a retirement plan are a qualified plan you can control, so the employer can set some stipulations, eligibility, vesting, things like that. Help your employees and yourself invest now for financial security and retirement. The employer contributions are tax deductible. Employer-paid administrative expenses are tax deductible. So, for instance, a fee paid to your third-party administrator is deductible on your taxes. They may, if this is their initial plan, they may qualify for a tax credit of $500 for the first 3 years. So, again, if you're paying a third-party administrator more than $1,000 a year for your first 3 years, which in all likelihood you would be, you get a $500 tax credit. Assets in the plan grow tax deferred, which basically means they're taxed when you take it out, hopefully at retirement at age 65 or later. 401k plans can help you attract and retain employees. A lot of employers or employees, especially if they're, I'll say, 40 or older, their first question might be, do you have a 401k plan? And it also provides potential for larger contributions to some of the owners or key employees. Again, the limits of these state-run plans are going to be your IRA limits. So $5,500 if you are less than age 50, and $6,500 if you are over age 50. So you can contribute substantially more in a 401k plan than you are going to be able to in these mandatory state-run retirement plans. All right, we'll also discuss some potential changes to the Form 5500. The IRS, the Department of Labor, and the PBGC use these forms to gauge retirement plans. They're hoping that this revamped or updated form is going to modernize the financial reporting, improve service provider fee information, help plan compliance, and also give them more information to publish for other retirement plans to look at. So some of the top 2 are your main changes. Currently, if you have a health or a welfare plan with over 100 participants, you have to file a 5500. One of the changes would be that all group health plans, regardless of size, have to file a Form 5500. It's estimated that they'll get more than 2 million to 2.5 million additional filings every year. Defined contribution counts for audit purposes is going to be based on participants with account balances. Currently, if you have an employer with, say, 150 participants, but only 70 are actively participating in the plan, since they have over 100, that plan is required to be audited by an independent CPA firm. What this would do in that same situation is if you only have 70 participants with balances in the plan, you would no longer have to have an audit. That's a considerable savings for the employers to not have to pay an auditor to audit their plan. They're going to expand the categories for Schedule H, which is the financial information. The Department of Labor and IRS realize over the years there are a lot of hard-to-value assets, a lot of limited partnerships, a lot of investments that weren't traditional retirement plan investments of stocks, bonds, and mutual funds. So they're expanding the categories to look for information about other types of investments. Fee disclosures. Fees are a big thing for the Department of Labor, as Joe mentioned in his presentation. There is a 404A5 participant fee disclosure that your plan participants get annually. It typically is provided by the record keeper or firm provider, so if it's American Funds, they might get it from American Funds or Transamerica. This discusses the fees that they pay within the plan and the fees of the various investments within the plan. Some of the questions are just more informational questions by the DOL, the IRS, and the PBGC. For instance, if the plan has brokerage options, it wants to know the number using the broker options. It wants to know the number of participants making catch-up contributions, the number of participants receiving the maximum employer match, the number of participants that made contributions during the plan year. Really what this means, it's a lot more work for your third-party administrator, and it'll be more work for the employers and plan sponsors to accumulate and gather this additional information that's going to be required on the Form 5500. And most of these changes are anticipated to be not to be reflected until the plan year that begins in 2019. So it's nothing we have to worry about immediately. It's set to take effect for plan years that begin in 2019. So some potential legislation. There was a bill out there, the Retirement Enhancement and Savings Act of 2016, that talked about some key provisions that could possibly be changed. This will not go through, but it's always nice to look. Typically, when these things are in a bill, eventually there'll be something else in the bill that'll get passed, and this retirement stuff is just an attachment to that bill. So it's always nice to look at things they are considering, because these things typically will keep popping up in later bills. So one of the things that would permit unrelated employers to participate in a new type of multiple employer plan, a pooled employer plan. So again, what that would allow us to do, just say Sikich or another TPA firm, we could take a small doctor's office, we could take somebody that has a factory, we could take somebody that owns a Jimmy John's, and possibly put all of them in the same retirement plan, thereby saving each of those employers money in costs. The investments would be pooled, they'd all have the same selections, so they're economy-wise, we can get them in a better share class. This would be a good change. Another thing that they're looking to do is requiring defined contribution participants to receive an estimate of their monthly income that their account balance could produce in retirement. I believe this has already been enacted in a lot of time. It's not currently a law, but a lot of providers have started to do this. If you'll notice on your account statements, a lot of times it'll tell you your balance is $100,000. It'll project what your balance is going to be, and then it will further project how much that would be in a monthly retirement income. One of the negative impacts would be to the required minimum distribution rules in the event of death. Currently, if my mother passed away and left me with $1 million, I can roll that $1 million over to an inherited IRA and then take that $1 million out over my life expectancy. So over the next 25 or 30 years, whatever my life expectancy is. What this would do, and it's a definite revenue raiser, is they're looking to require that to be paid out over 5 years. So again, if my mom passed away and left me $1 million, I would be required to take $200,000 in income over the next 5 years. A definite revenue producer for the IRS. The account balances of less than $450,000 would be exempt. This would also relax a little hardship distribution rules. Currently, you can only take out as a hardship distribution in a plan what you have contributed. This would allow you to take out, in addition to what you've contributed, all your earnings. So in essence, you could liquidate your balance. And you would not have to take a loan first. Typically, you have to take a loan first as well. It would remove the automatic escalation for automatic enrollment plans. Currently, you can auto-enroll somebody and increase them 1% a year up to a 10% limit. There's talk about they would remove that 10% limit. It would be more flexible in regards to safe harbor plans, eliminate the safe harbor notice for non-elective plans, permit plan amendment to become a safe harbor plan 30 days before the end of the year. Currently, you have to wait until the following year. And also even permit a plan to be amended within the last 30 days of the plan year, provided they contribute at least 4%. It would also increase the small employer startup credit, which I mentioned before, of $500. The maximum would be $5,000, and it's really based on the size of the employer. So the credit would look at the size of the employer. It would also allow an employer to adopt a qualified plan after the close of the tax year, before the due date of the tax return. Last, we'll discuss some common errors in retirement plans. Keeping your plan up to date is of vital importance. Most plans had to be amended and restated for the Pension Protection Act prior to April 30th, 2016. So most people have had their documents updated. If you are ever audited, they will look for plan documents and likely all your plan documents. So I would suggest you keep copies of all current and past documents. Hardship distributions are causes of some errors in retirement plans. The most common are failure to secure supporting documentation. So if somebody takes a hardship and it's for the purchase of a home, you should likely request the purchase agreement. If it's to prevent eviction, you should ask for an eviction notice. If somebody wants to take a hardship, they currently have to take a loan first, so you'd have to make sure they've exhausted their loan ability if the plan has loan provisions. You have to suspend their deferrals for 6 months. So if I take a hardship, I have to stop contributing for 6 months. And then in addition to that, once my suspension is over, you have to resume my deferrals. So this is another common error. I was deferring 5%. I took a hardship. You need to reinstate my deferrals at my 5% level once my 6-month suspension period is over. Excluding part-time or seasonal employees from the plan. You can exclude them in your plan, but keep in mind what the IRS classifies as part-time is less than 1,000 hours during a 12-month period. It's common for me to hear that you have part-time employees that aren't in the plan, but then I'll hear it's 25 hours a week. Again, it's only 20 hours a week to get to 1,000 hours. So your employees, if they work more than 1,000 hours during a 12-month period, they will likely be eligible for your retirement plan. Another common error is withholding deferrals. It depends on how it's defined in your plan, but keep in mind they're never withheld from severance pay. But typically what would happen is they might not be withheld from a bonus or a commission payment. So if I'm deferring 5% per pay period and I get a bonus and it's not taken from that bonus, it should be. Again, you'll have to look at your plan document to see how it treats special pay, such as bonuses and commissions. And failure to offer them withhold from this compensation is basically a missed catch-up contribution required by the employer. Same thing with employees on the next slide with temp agencies. Typically, if you hire a person through a temp agency, you need to look at their service while employed via this temp agency when if they become a full-time employee for you. So their date of hire is typically the day they begin working for you. All hours should be counted for service investing in the plan, and somebody expected to work full-time for at least a year may be deemed to be a leased employee. Leased employees can be excluded in the plan, but we have to look at them for coverage testing. So just keep in mind you may be required to offer benefits to leased employees if you fail coverage testing. Okay, and I will pass this along to Jenny Gribble. She's going to talk about some plan design considerations.
Thank you, Mike, and thanks for setting me up for the things I wanted to talk about as well. I'm another one of the directors in the TPA arm, the third-party administration arm of Sikich's Retirement Plan Services Division. And I'm going to touch on some plan design ideas, not exhaustive, of course, but things you might want to consider. Next slide, please. The first thing is there are two types of plans, and Mike referred to these acronyms, SEP and SIMPLE, that are IRA-based plans, so they're not technically considered qualified plans, although for these state-mandated plans, they'll be considered that way. But anyway, I'm guessing most of you do not have a SEP or a simple. You probably have a 401k plan or something else. But if you do, you may want to consider going to a 401k plan at some point in the future. SEPs are employer contributed only, kind of like a profit sharing plan, but they have to cover employees that work very part-time, basically people that have worked for you for at least 3 years and are making more than $600 a year, which would probably just be about everybody. The thing about SEPs is it's hard to maximize contributions for key individuals and without also maximizing what you're giving to your employees, and there's an example here of that. The big thing that I hear about SEPs is, well, if I go to a 401k plan, it will cost me more in fees, but that you probably make up for that in lower contribution costs to employees, just because there's more flexibility to move things along. Next, please. A simple plan is kind of the 401k version of a SEP. It allows employee contributions and employer contributions. Again, you have to cover employees that are working very part-time as long as they're making more than $5,000 a year. The employer contribution in a simple is required. It's basically either a 3% match or a 2%, what's called in our industry non-elective contribution, which basically means a fixed contribution to every employee regardless of whether or not they're contributing. To me, the big disadvantage of a simple plan is that 3% match or the 2% non-elective contribution, that's all you can make. If you had a very good year and you want to shelter more money or put more money in for your employees to reward them for the good year, you can't do it in a simple. You can only do what's allowed, and that's it. And again, you can make up for higher administrative costs and potentially higher contributions with higher tax deductions. There's an example down there that you can look at. One of the things I wanted to mention, though, is simple limits are lower, just like IRA limits are lower than 401k plans. Only $12,500 in deferrals if you're under age 50, as opposed to $18,000 in a 401k plan. One big caveat about simples and SEPs, if you started one, if you're contributing to one during the year, you have to finish out that year with that SEP or simple. You can't change mid-year. It's just one of those rules. Next slide, please. Mike mentioned automatic enrollment in one of his slides. If you're not familiar with that term, it's actually getting to be a hot topic in the industry. The government loves it. It's a feature that's designed to either increase employee participation, to help you pass the discrimination testing that's part of a 401k plan, or to kind of save employees from themselves in a more paternalistic outlook to assist them in accumulating money for their own retirement. The theory behind automatic enrollment, and it used to be called negative elections, which is a rather descriptive term as well. The theory behind it is that most employees, or a lot of employees, will not enroll in your plan proactively just out of not getting around to it. So if you do the reverse, if you say, well, you're going to be enrolled unless you opt out, many of them will not get around to that either. And that means their money will get put into the plan and accumulate for them and help you in terms of your average deferral percentage for your non-highly compensated group in terms of testing. So that's the theory. Employees have to be given advance notice. There's an annual notice, just like the fee disclosure, that has to be given out 30 days before the beginning of the year. You can set your, depending on the type of automatic enrollment you use, you can set your percentage that you're going to enroll them at pretty much anything. I have some clients that do 1%. I have some clients that do 6%. The most common one, I think, is 3%. You can also put in what's called a automatic increase feature where, okay, I'm starting you at 3%. Every year, again, unless you opt out, I'm going to increase it by 1%. So again, you're helping them save for retirement and continue to increase what they're putting in. You do have to have, with automatic enrollment, what's called a qualified default investment, which most of your plans probably have now, such as target date funds, so that once they're automatically enrolled, without them opting to do it, you're putting them in an investment that the government deems to be a prudent investment. One thing about automatic enrollment requires some more administrative stuff on your part in terms of tracking who's auto-enrolled, the auto increases, those kinds of things. Some of the record keepers will allow that or will provide that service for you, but not all the time. Okay, so next I want to talk about matching contributions. Matching contributions are not always in every plan, in 401k plan, but they can be. And they can be hard-coded into the plan document, or they can be discretionary. You can determine year by year whether you're going to match, how much you're going to match, whatever. It's another one of those things that encourages employees to contribute. Lately, I've had a lot of clients tell me that they keep trying to get employees to start to participate, but they don't offer a match, and employees are just like, I'm not going to put my own money in if you're not going to match them. To a certain extent, they're shooting themselves in the foot, but I understand that. So it can help you with testing to offer a match to encourage people to do it. A lot of times at an employee meeting, I'll hear the presenter say to the employees, they're going to match you up to, say, 3% of what you put in. Put 3% in. Don't leave free money on the table. So that's, again, one of the ways a match can help you encourage employees to contribute. A couple of ideas. If you are going to use a match, if you're not already, make sure that you put a cap on your match. So, for example, rather than saying I'm going to match 50% of anything you put in, so you have, depending on what people elect to put in, you have no way of gauging how much your total exposure is. On the other hand, if you say I'm going to put 50% of what you put in up to 5% of your pay, you're limiting yourself to a maximum exposure of 2.5% for every last person in the plan. So I would always encourage you to put a cap on any match you decide to do. And the other thing you can do is if you're currently matching, considering lowering the percentage match and increasing the cap. So in the example, say you're matching 50 cents of deferrals on the first 4% of pay right now. Consider going 25% on the first 8%. Your maximum match is 2% either way, but that way you encourage employees, rather than just doing 4%, to maybe doing 6% or 8% to get more of the match. Again, if you're having issues with your discrimination testing, highly compensated employees are limited in what they can put in, or they're getting refunds, that's a way to maybe help increase the percentage for the non-highly compensated group and address that issue. Next, please. You heard Mike refer to safe harbor plans, and you may or may not know what those are. Typically, clients that have them are very well versed in them, but if you don't have it, you may not have even heard of that terminology. Again, if your plan has a lot of testing issues, or if your plan is top heavy, and what that means is that more than 60% of the account balances are for the benefit of key employees, and if your plan is top heavy, you typically have to put in a 3% contribution for all of your non-key employees. Then you might want to consider adding a safe harbor contribution feature. A safe harbor plan is deemed to pass the average deferral percentage discrimination test, and in most cases will also meet the top-heavy minimum contribution requirement. Even if you're using the safe harbor match alternative, which I'll talk about in a second, and people aren't contributing, so they're not getting the match, it's still deemed to meet that top-heavy minimum contribution requirement, as long as you don't put any other money in the plan. If you have an existing 401k plan, you can only add it as the beginning of the year, so it's too late for 2017. But you may want to talk to your TPA, and that could be us, about adding it for 2018. You have to amend the plan and give notice by December 1st of 2017 to add it for 2018. There are two options for safe harbor. It's kind of similar to a simple 3% non-elective contribution, or up to a 4% match. The regulatory match is a two-step one, but basically dollar for dollar up to 4% is what you're looking at there. It has to be 100% immediately vested. You can't have a vesting schedule. You can't impose any what we call accrual requirements, like last day of employment or any minimum number of hours to receive it. And again, you have to provide a notice at least 30 days in advance. But if you're ending up putting in your 3% safe harbor or top-heavy minimum anyway, you may want to consider going to Safe Harbor and biting the bullet on some of those parameters. Makes life a lot simpler in the long run in terms of testing. Next slide. Okay, I want to talk a little bit about profit sharing. The beauty of a 401k plan, in my mind, is that you can build in a number of different features all in one plan. You have to have employee contributions, but they can be either pre-tax traditional employee contributions or Roth or both. You can add that in there. You can have match, you can have safe harbor, you can have profit sharing. The only one of those things that really is a required thing for you is safe harbor if you decide to go that way. Everything else is really flexible within the plan. So if you are doing profit sharing, there are 3 different allocation options for the most part. The most common one is proportional to pay. Everybody gets the same percentage. If you're putting 10% in for yourself, you're putting 10% in for everybody. The second one is one that kind of weights the contributions towards those who are paid more. It's called integration with Social Security. And what it does is it gives an extra percentage to people who are earning over the Social Security tax base. And you play some games with how you do that. But basically, it's those folks that are earning a lot of money over the Social Security taxable wage base. If you're not aware yet, the taxable wage base went up the highest percentage I've ever seen it go up for 2017. It went from 118.5 up to 127,200 for 2017. So it'll be interesting to see how that affects our plans that use integration with Social Security. Also, the compensation limit on what you can count in the plan went up to 270,000. So basically, this kind of an allocation formula works best if the key individuals, the people you want to benefit the most, make quite a bit more than the taxable wage base. So if they're making more than 270,000, you're giving them an extra percentage on what they make between 270 and 127.2, and that's how it's weighted in terms of pay. The third and final allocation formula I wanted to talk about, and again, it's actually one of the most prevalent. Next slide, please. Is called cross-tested, or you may also hear it called new comparability. And this one is more of an age-weighted type of allocation formula. It works best with like a 10-year difference between the average age of your highly compensated employees and the average age of your non-highly compensated employees. And it basically tests for discrimination, not on a percentage of pay that you're giving to people, but on what they would accumulate to at retirement age. So that's why it's called cross-tested. You're testing not on a contribution basis, but on a benefit basis. What are they going to get at age 65? And it's based on the theory that $1 for a 25-year-old employee is going to be worth more at age 65 than $1 you're contributing now for a 55-year-old owner. So again, it's pretty prevalent in a lot of plans right now, and almost always when we're looking at these kinds of things, it's going to come out as a better allocation in terms of favoring key individuals than any of the other allocations. The only time it won't is when your owners are quite a bit younger than the employees. And finally, I wanted to talk about defined benefit or cash balance plans. Cash balance is a type of defined benefit plan. So if you really want to increase your tax deduction significantly, or you need more rapid accumulation of retirement assets, consider, for example, the owner who's, has his own small business. He's been putting everything he makes back into the business for years and years, and he wakes up one morning and says, oh my, I'm 55 years old, and I don't have anything saved for retirement. Obviously, the sale of the business might give him some money for retirement, but other than that, he's had nothing to put away. So a defined benefit plan can allow that kind of an owner to accumulate a lot of retirement assets in a hurry. Just like cross-tested profit sharing, it favors older employees, works best with a good age spread between the individuals you want to benefit and the rest of the employees. But potentially, you can get an additional contribution for each key individual of $100,000 to $200,000 apiece. Big caveats on defined benefit plans. It's only company contributions. They're required. most actuaries, and you need an actuary for one of these, will tell you that they think the plan should be around for at least 5 years for the IRS to consider it a quote-unquote permanent plan. And what I always tell my clients that are considering defined benefit or cash balance plans is don't do it if you don't think that you can sustain that level of contribution for at least 5 years. Unlike profit sharing, you can't decide year to year what you're going to contribute. But if you can support that kind of a commitment, it's a great tool for getting bigger tax deductions and for allowing the individuals you want to benefit the most to get more money in for retirement. Usually you add a defined benefit in addition to your 401k plans. You're maintaining 2 plans at the same time. They can be tested together. They can be combined together to pass discrimination testing, and that will help control the costs for employees. But it does require an actuary, which means there are higher administrative costs. Almost every one I've ever seen, the additional tax deduction and the corresponding tax savings will more than cover the additional administrative costs and the additional contributions you might have to make for employees. So it's something to consider. In the handout section of the control panel that Joe referred to in the beginning, there is one handout called RPS Plan Design Booklet. That one has some numerical examples, based on a sample company, sample employee group of both the profit sharing allocation formulas and of this defined benefit 401k combination of plans. So it's one of the handouts you might want to take a look at later after the presentation. Please feel free, our contact information is on the last slide, but please feel free to contact either Mike or me if you want to discuss any of these plan design ideas in more detail pertaining to your own specific situation. And with that, I will hand it back to Joe.
And now we'll address some of the questions that came in during our presentation. And question 1 was, what do you recommend the amount to be for fiduciary liability insurance? And of course, this does vary a little bit by plan size, but in practice we would suggest that a plan organization determine if your provider provides any fiduciary coverage for you. Typically providers are not fiduciaries and they don't have coverage, but you do want to make that clarification clear. Maybe your advisor, if they are serving in that fiduciary capacity currently, has coverage, so you want to make sure of that. But without their coverages, we would recommend a minimum coverage of at least $1 million. And again, that is depend upon your plan size, but $1 million should be suitable for most plans up to that $100 million plan size. And then also make sure your coverage does include litigation expenses, and your deductible would be a negotiable aspect of your coverage. And a typical deductible might be $2,500 or $5,000, but if you wanted higher limits, going to a $10,000 deductible, if the organization could manage that cost, might be appropriate to give you higher coverages. So thank you for that question. And then a second question that came in was, how many people would you recommend be on a retirement plan committee serving in that fiduciary capacity? And again, a very common question, and we get, and is dependent a little bit about employer size and plan size, but typically we would like to see at least 3 to 4 people on a committee, so that if one person is absent, the committee could still make decisions and move on from investment reviews and other committee actions they may take. If your committee just has 2 people on it and one person is gone, they may not feel comfortable approving some of the fiduciary actions. So thank you for those questions, and thank you very much for your time this afternoon.